The macroeconomic data most likely to grab the headlines of the coming week are the latest UK unemployment figures. They will be released by the Office for National Statistics on Tuesday the 23rd of February. The last published unemployment rate was 5%, as 1.72 million people were out of work, and that meant that some 360,000 people had lost their jobs since the start of the pandemic. Now, it could have been worse, as around 2.4 million people were still on the furlough scheme too, and that has helped to keep the unemployment rate down. Now, I also know it will be no comfort at all to those who have been unlucky enough to lose their job, but the UK's average jobless rate since 1971 is actually 6.8%, and we're still below that, so again, that's something. However, the Bank of England is still thinking that the jobless rate could peak at around 7.5% later this year, so there's plenty for Chancellor Rishi Sunak to ponder as he prepares for his budget in March. This is particularly the case when you look at the claimant count. This stands at 2.6 million people, and it measures not just those who are out of work, but those who are having to claim other unemployment-related benefits such as universal credit, and not just job seekers' allowance. The final figure to watch is wage growth. Now, if you've been fortunate enough to keep your job and avoid being furloughed, the good news is inflation is low and wage growth is outpacing it, so those people are better off, especially as I would guess the commuting costs are a lot lower as well. Now, I guess this also underpins the view of Andy Haldane, the Bank of England's chief economist, that the economy is primed to bounce back, as this group of people could be ready and poised to get out and spend when they feel it's safe and when they're permitted to do so. The last published figure for wage growth, including bonuses, was 3.6% year on year, inflation being less than 1% at the time. Now, on the company front, almost a sixth of the FTSE 100's members will report full-year results in the coming week, and a number of mid- and small-cap firms will also update their shareholders on trading. Names which may be worthy of further research include the following, although do please note that these dates are still potentially subject to change. Intercontinental Hotels and HSBC on Tuesday the 23rd of February. Reckitt Benckiser, bookmaker and bid target William Hill and Metro Bank on the 24th. Then on a bumper Thursday the 25th, Anglo American, Mondi, BAE Systems, Standard Chartered, Serco, Aston Martin, Lagonda, Vistry, Centrica and others, before International Consolidated Airlines, RSA and Rightmove will close out the week on Friday the 26th. Now, that's a heavyweight list, but the company which could cause an even bigger fuss in the week ahead is Lloyds. The bank's due to report its fourth quarter and full year results for calendar 2020 on Wednesday the 24th of February. Now, as you might expect, given that in 2020 the UK suffered its deepest contraction economically since 1709, Lloyds shares have done pretty poorly over the past year. They're down by around a third, hampered by that downturn, increased loan losses, competition from fintech rivals, flattened yield curves, of which more in a moment, and regulatory pressure to withhold dividends. And it's to the dividend that analysts and investors may turn first. The Prudential Regulatory Authority appears to have cleared the way for Lloyds and the big five FTSE 100 banks to rejoin the dividend list, although the lenders may still choose to tread carefully. After all, we're still in lockdown and the near-term economic outlook is uncertain, even if Bank of England Chief Economist Andrew Haldane is again, for one, bristling with confidence when it comes to the outlook for the second half of the year and beyond. Now, analysts are looking at Lloyds and they're forecasting a dividend for calendar 2020 of 1 penny a share, and that comes ahead of a possible increase to 2 pence in 2021, although that would still be below the pre-pandemic peak. So the dividend may be the headline figure at Lloyds, but analysts and shelves will then want to dig a little bit deeper. They'll turn back to pre-tax profit, where the consensus is for a pre-tax income of £1 billion, down from £4.4 billion in 2019. In the unlikely event Chief Executive Antonio Horta Osorio gives any guidance for 2021, analysts are currently looking for pre-tax earnings of £3.3 billion. Again, still below the pre-pandemic peak. Now, in terms of what shapes those profit figures, two factors in particular will come in for scrutiny, especially as Lloyds now seems to be past the worst when it comes to compensation for the payment protection insurance scandal and other conduct and litigation issues. The first one is the net interest margin, the percentage profit that Lloyds makes on its loan book. This has been sliding lower and lower as central banks anchor interest rates at record lows and basically manipulate yield curves to flatten them. At least Lloyds' net interest margin showed some signs of stabilisation in the third quarter at 2.42%, and management has forecast a broadly unchanged figure for the fourth quarter. The second is impairment charges, write-offs against loans gone sour. Lloyds took charges of £1.4 billion in Q1 and £2.4 billion in Q2, but then just 300 million in Q3 as lockdowns eased and the economy found a little bit of momentum. It'll therefore be interesting to see how conservative Lloyds chooses to be in Q4, although management has guided towards the lower end of its anticipated full-year range of 4.5 to 5.5 billion, and that implies around 400 million of loan write-offs in the fourth quarter alone. The last figure to study comes from the balance sheet. At the end of the third quarter, Lloyds' tangible net asset value, or NAV per share figure, was 52.2 pence. And as I record this, the shares trade at 37 pence, a 30% discount. Some investors may therefore argue Lloyds shares are cheap if, and I stress, if, the bank sustainably improves returns and equity, or proves that the asset valuations are completely reliable. And in the latter case, a drop in asset impairments would certainly help. I hope that you and your families are all in good health and good spirits during these difficult times. Thank you for listening, and I look forward to talking to you again next week.